Let's get insight now from Pierre Ouimet. He's head investment strategist at UBS Canada. Pierre, it's always great to see you. Thank you very much for joining us. Looking at the market, the US market in general, you see room for optimism. For example, corporate profits still pretty strong, and you think tariffs will eventually be targeted. They won't just be a blanket imposition.
Yeah, well, starting off with tariffs, which is kind of the main issue right now, is being used mostly as a negotiating ploy, I think, right now to extract some concessions out of U.S.'s trading partners, maybe not necessarily on the trade side. Some countries are being targeted for trade in particular, like China, Mexico. I'm not too sure, honestly, why Canada's wrapped into that whole issue as well. But I think they're trying to extract more concessions on the border and some defense spending issues, things of that nature out of Canada. So I think that's where we're at right now. And as far as the market's concerned, I mean, we're in that phase of the market now where it's the only thing that can drive markets higher are really earnings. So we're focusing on that very, very strongly.
Yeah, because I suppose big interest rate cuts in the U.S. are not on the table. I think the market's only pricing in one reduction in 2025.
Yeah, 40 basis points, I think, is what the futures market is saying. So, I mean, there's some people that are saying it could be 75 basis points. Merrill Lynch is saying no more cuts. So it runs a gamut. It'll all depend on inflation. And as the minutes of the FOMC has shown, I mean, there's a great debate going on right now. And I think most people on the FOMC would argue that inflation is more of a concern than full employment. We pretty well have full employment in the U.S., and with tariffs and potentially a tightening up of the labor market as well, following maybe some layoffs and things of that nature, that could cause some worry about inflation. Also, we have goods inflation is starting to rear its ugly head, although the services side continues to creep downward. So it's kind of a mixed bag, and I'd call inflation sticky, and I think that worries the Fed.
Talk to us about
the bond market.
Worries the bond market as well. Sorry, Pierre. Talk to us about gold. It's been hitting record highs. I see that Christine Gilfillan, who's head of U.S. precious metal strategy, she's positive on the sector overall, but she does think gold is vulnerable to a pullback in the near term.
Well, I guess when something has risen as much as gold has, it's always vulnerable for a pullback. But I mean, I think the tailwinds are still there. Central banks continue to buy massively, and it's inflation is probably going to stick around 3%, might actually move up. If it does, it could be a little bit more worrisome as well. I mean, gold is viewed as an inflation hedge. It's also viewed as a hedge against disaster and bad policy moves, and so I think gold, there's a place in the portfolio for gold. And in turn, just to preserve the value of the currency, really, because most governments right now are devaluing their currencies, and that's been going on for a number of years. And probably the only way out of the U.S., I mean, this is my personal opinion, and the only way out of the debt problem is probably to inflate your way out of it, quite honestly, because as we can see, I mean, they can find all sorts of graft and excess spending, but they'll never find the amounts of money that they're looking for in order to eventually balance the budget. That's way, way beyond the realm of the possible here over the short term. And you have a whole bunch of other issues. I mean, the tax issues, what's going to happen with the tax cuts? Will they be prolonged? What's going to happen with corporate taxes? And, the U.S. economy is going to slow. And maybe by the mid this year, probably you'll start to see some impact on the labor market. It's not going to be dramatic, but it's going to be slow enough to probably give the Fed an opportunity to let up on rates a little bit more. But, I mean, we've seen a lot of movement on rates, particularly here in Canada, and it's probably unfair to expect that we'll have something as dramatic as that going forward, unless you go into a recession.
It's interesting. Apparently, there is a constituency in the U.S., some of them may be close to the White House, who think, we should drive down the U.S. dollar, make our exports more competitive, for example.
Yeah, sure. There's no doubt that a strong U.S. dollar is not going to help corporate earnings in the U.S. And since that's where we're focusing on, we're quite surprised actually to see this. The fourth quarter was up 12.5%, and revenues were up about 5%. So there's even then at record margins, we're still seeing some expansion in margins in the U.S., which is quite surprising at this stage of the cycle. But going forward, we're looking at 2% growth in the U.S. and inflation probably around 3%, so 5% nominal growth, will translate into about 5% revenue growth, and 5% revenue growth can easily turn into 10% profit growth. So that's I think where our cautious optimism lies, is in the sustainability of earnings going forward. And if the U.S. dollar does weaken, I mean, that's going to be even better. Right now, the Canadian market is benefiting from the strong U.S. dollar, the weak local currency, as well as the euro. And we've seen a shift of monies that have gone from technology stocks here in the U.S. And a lot of money has moved towards foreign markets. Actually, the Euro Stocks 50 is up 12% year to year in a euro basis. So it's money is shifting elsewhere, and that's probably also. It's also probably migrating. I think we're seeing a shift in capital flows away from the U.S., particularly since the election of Donald Trump, and particularly since his use of tariffs as a bargaining tool. I think the market does not necessarily appreciate that, and I think investors are starting to vote with their feet, and they're moving to other jurisdictions, including Canadian equities.
That's interesting. Yeah, I mean, I suppose our dollar has rallied, our loonie has rallied, gone above 70 cents U.S.
I mean, it's surprising that it's holding in that well, but under the threat of tariffs. But I think a lot of people just realize how unjust they really are vis-a-vis Canada. I mean, you can't lump us in with a lot of the other trading partners that have been, they've been abusing the system to a large extent. It's not been the case for Canada. And why we should also be lumped in with Mexico in some kind of a trade agreement. I mean, those are two totally different economies. And, these notions of country of origin and using these countries as a way of pushing exports into the U.S. market. Canada doesn't do that. And actually, we've been a source of disinvestment over the last 10 years. So it's not as if you're seeing a lot of companies build plants in Canada to sell into the U.S. That's just not happening, which is the case with Mexico. So why we have to be lumped in with them is really perplexing for me. And the bad treatment, particularly the kind of off-the-cuff remarks about Canada, given our history and our relationship with the U.S., I think has got Canadians really, really upset for the first time in a long time. It seems a lot of unity starting to emerge around this whole issue. So hopefully we do something here in Canada to redress the situation, diversify exports, possibly eliminate some of the interprovincial barriers, and unite around the fact that we have to, at some point, we got to get our own house together and do the things that we have to do in terms of protecting our borders and assuring our sovereignty, particularly in the north, and things of that nature. I think we'll see more and more push in that direction as we go forward. I think that could be, overall, it'll be good for Canada, for sure.
Thank you very much, Pierre.
Pierre Ouimet, pleasure. Thanks.
Head Investment Strategist at UBS